Good day, participants. We would be talking about Chapter 17 of CFP 2. Chapter 17 is about insurance pricing. So, we will try to understand how the insurance premiums are priced. First of all, we should understand that insurance charges a price for giving the insurance cover, and this price, we say that this is a premium. So basically, premium is the cost of giving the insurance cover to the insured person. Insurance companies also refer to the pricing as rate making process of insurance. Now, insurance pricing definitely differs with the pricing of any other product. In the process of rate making, there are two objectives. One is regulatory objective and the other is business objective. So regulatory objective is because there are regulating bodies, and the aim of the regulating authorities is to safeguard the interest of the policyholders. And this is also the duty of the regulating agencies to ensure that insurance companies remain solvent, they are able to pay their liabilities for their short-term liabilities, also their long-term liabilities also, because they are in the insurance business, so they should be able to pay the claims as and when the loss occurs. The other objective is business objective. Now, as part of business objective, insurance companies have to ensure that, again, they have to ensure that they remain solvent, they make profits, they don't overcharge, the premiums are competitive, premiums are low so that they can be easily affordable by the people, and they are marketable. So let's understand what are the various components of a premium. If we talk about life insurance, first of all, let's start life insurance premium. In the case of life insurance, because life insurance covers the death risk of an individual, so therefore the first component of a life insurance premium is components of premium. So the first component would be risk premium. What is risk premium? Risk premium is the premium which is required to cover the death risk of an individual of a particular age for 1 year. So therefore, risk premium depends on the mortality rate of an individual of a particular age. And as I said, that this mortality premium would be for 1 year. Now, insurance companies would be getting this risk premium from a large number of individuals. Now, claims would be given as and when the loss occurs, as and when the death occurs in the case of, say, life insurance. So, initially, insurance company would be having risk premium in the form of a lump sum. Definitely they would be investing it somewhere. So while investing, they would also be earning an interest on it. So therefore, insurance companies have to factor in the interest earned on this risk premium. So therefore, the prudence says that they should reduce this interest earned from the risk premium, and they should charge only the net premium from the customers. So therefore, we would say, if we deduct the interest factor from the risk premium, then what we will get would be called as the net premium. Now, this is the premium which the insurance companies would be charging on account of the mortality risk from a person. This net premium is also known as the pure premium. Now this is not the premium which would be offered to the customer, because this is just, you can say, in the case of an industry, this is just the cost of raw material. Now the industry also has overheads. Similarly, the insurance industry also has to add certain expenses which they incur. For example, so they have to add expenses to the net premium. Now what are the expenses? Expenses are in various forms. For example, selling expenses, there would be administrative expenses, there would be policy issuance expenses, there would be underwriting expenses, there would be medical tests under expenses, etc. So all these expenses incurred on this particular policy. So they will calculate a proportionate value of expense that should be charged to one individual. So so all these expenses would be added to the net premium, and then what we will get after adding the expenses, which will be known as the office premium. Now again, this office premium also would not be offered to the customers commercially, because there are a few adjustments which will have to be done in the case of office premium. Few adjustments in the sense, the insurers calculate the mortality risk on a particular individual based on his or her age. But practically sometimes they find that in certain ages the mortality rate doesn't increase, although there is an increase of age. And in some particular years or in some particular circumstances, they find that in spite of the fact that a person is slightly older in age, but the mortality rate practically would be more in lower ages. For example, in some earlier years, it was found that the mortality rate in the age group of say 15 years to 18 years was more than in the age group from 21 to 24. So therefore, in spite of the fact that the age is less, the mortality rate is more. So these kind of adjustments need to be done finally in this office premium. So there can be plus minus adjustments. Now these adjustments can be due to adjustments in mortality. These adjustments again can be due to certain other expenses, due to contingencies, etc. So after factoring in these adjustments, now what they arrive as is known as the tabular premium. Now this is the premium which is offered to the customers commercially. Since these premiums are given in a tabular format in the case of life insurance, therefore they are known as tabular premiums. Tabular premiums in the sense that in the case of life insurance, they are in the form of a table. Normally you will find that in the column there would be age, and in the row it would be the term of the plan. For example, a particular plan starts from the age of 18 years. So it will have various ages, 19, 20, 21. Let's assume that the maximum entry age in this plan is say 60 years. So all these ages would be mentioned here. And suppose the term starts from, the minimum term is 5 years, so 5 years, 6 years, and let's say the maximum term is 25 years. So all these terms will be given in the row. So if one wants to find the premium of a 25-year-old person for the term of say 25 years, so one will see the premium rate here. And life insurance premium rates are specified in terms of per rupees 1000 sum assured. And the tabular premiums would always be in the annual mode. So this is the industry practice, So if one wants to know the premium of a particular age for a particular term, one can find it from the tabular premium and then convert it into the specified sum assured which is required by the customer, and also convert it if the premium mode is say half yearly or quarterly or monthly, so accordingly it can be adjusted. Now this was about life insurance. Now to talk about the premium pricing in broad terms, wherein the premiums are calculated for general insurance also. Let's consider what is the basis for the insurance companies. Now, insurance companies, they have to take into consideration the concept known as exposure unit. What is an exposure unit? Exposure unit is the unit of measurement used in insurance pricing. For example, in fire insurance, the exposure unit is in terms of rupees of risk coverage. In the case of motor accident insurance, the exposure unit would be risk in terms of a vehicle insured per year. In the case of life insurance, as we discussed earlier, the exposure unit would be on the basis of an individual. So therefore, insurance companies tend to calculate, like in this case, our exposure unit was an individual, so insurance companies try to calculate what is the risk per person, risk premium. Similarly, in the case of say motor insurance, the companies would take into account how many vehicles are going to be insured, how much of loss would happen. They would have to calculate a probability of the happening of the loss. Now this probability is calculated on the basis of past experience, past statistics, past data, and based on that a future probability is calculated. In other words, you can say, to understand it clearly, a simulation for the future figures is done. So, it's also very important for an insurer to classify the risks. Now, classification of risk is again important. For example, in this case of life insurance, risk classification is done on the basis of individual's age, because as the age increases, the risk increases, so classification has to be done on the basis of age. Classification can also be done on the basis of occupation of a person. If a person is in a risky occupation, or in other words, if some occupational hazards are associated with his profession, with his occupation, with his work, place of work, then definitely the risk can be classified according to the occupation, according to the habits, according to the diseases carried, according to the illness carried, according to the health conditions of a person. Similarly, in the case of motor vehicles also, we have to classify the risks, whether it's a personal vehicle, whether it's a commercial vehicle, whether it's a 100cc motorbike, two-wheeler, it's a 150cc motorbike, similarly for four-wheelers, similarly for commercial vehicles, there can be further sub-classifications, whether it's bus, whether it's a trailer, whether it's a truck, and of what capacity, what's the unladen weight allowed for a particular truck, what is the full load allowed for a particular truck, depending on its size, etc. So accordingly, insurance companies have to classify these risks, and they have to calculate the premium for each classification differently, for each group differently. So in other words, we can say there would be different pool of funds or different pooling of losses for different classifications. This is very necessary. Now this is also very necessary for insurance companies to ensure that the premium charged is adequate. It should not be less, so that insurance companies do not have to incur a loss, because they are responsible to all the policy holders, and since it's a collective effort, so therefore the onus lies on the insurance companies. They are in a sense like a trustee. So they have to ensure that the rate charged are adequate and at the same time they are not excessive, so that they are marketable and they are easily affordable by the people. Number 3, they have to also to ensure that the rates are not unfair or discriminatory. And in terms of business objective, again we can say that rates should be simple to understand. For example, in the case of life insurance, we know about unit-linked plans or variable plans. If there are a lot of complications in understanding the pricing of a product, then the customer would tend to drift away from that plan. So therefore, all those expenses should be clear. What are the, for example, in unit-linked plans, what would be the mortality charges, what would be the administration charges, what would be the fund management charges, what would be the switching charges, what would be the fund allocation charges, etc. So they should be transparent, they should be segregated as per regulators' guidelines, and they should be easy to understand. So the insurer also has to ensure this. Insurer has to ensure that the price is stable also for the coming times, because if the price or the premiums changes very frequently, again it will send a wrong message in the market. So therefore they have to ensure the stability. They have to encourage loss control also among the policy holders. So premiums should be as such, and the policy terms and conditions and wordings should be as such, so that they can ensure that the insured person should not become reckless after taking an insurance. Because besides physical hazards and occupational hazards and moral hazards, there is another term which is known as moral hazards. The insurers, the insured person or other intermediaries connected to that should not become reckless towards the loss. So, and insurers also should encourage or propagate or promote loss control or loss prevention measures. For example, in industries, fire, loss due to fire, loss due to accidents. So a safety drive should also be undertaken by the insurance companies. So it is said that if the premiums would be reasonable, then these kind of loss control activities would also be undertaken by the concerned industries, by the concerned individuals, and insurance companies also have to ensure that while pricing the product. Now, we would understand what are the other bases of rate making in the case of insurance. There can be another classification of rate making in terms of insurance. One is the judgment rate making method, other is the class rate making method, and third is the merit rating method. As I said about class rate making method, class rate making method is to classify the different risks differently and then to calculate the exposure unit in the different classification and accordingly calculate how much of loss is going to happen and how much of insurance would be sold, how many people would be covered. So we would divide the total loss among the total people to be covered. So that would be the amount to be charged on each exposure unit. So that is the basis of class rating method. In the judgment rating method, the actuaries use their own judgments to make the forecast for the future. So it's mainly dependent on the judgment of the actuaries as well as the underwriters, because underwriters are also involved in case of some companies wherein they work in tandem with the actuaries. The third basis of rate making is merit rating. Merit rating is quite prevalent in group insurances, whether in the case of life insurance or in the case of general insurance. Merit rating has further classification of a rating which is known as an experience rating. In experience rating, the insurers charge the premium as per its previous experience. If, let's say, if in a particular year the insurance company charges a certain amount of premium. Now after the end of this particular period of this particular year, they would calculate what was the amount of claims given for this particular group. If the claim is given is more, then in the subsequent year the premium would be enhanced so as to make up for that claim. Now let's assume that in the subsequent year the claim rate was lower. Now in the further subsequent year, now again the premium would be reduced. So therefore in the experience rating, the premiums would depend upon the claim experience of the insurer. So the premium can be raised also in the case of bad experience, and the premium can be reduced also in the case of better experience, or you can say low claims. This kind of method, which is experience rating method, is quite prevalent in group insurance, as I said, and it's also shows a win-win situation wherein the insured is also satisfied that our premium can also be reduced. So therefore loss control measures can be undertaken by the insured party. Now let us understand the various methods by which the premiums can be calculated. Let us understand the method called loss ratio method. Now in the case of loss ratio method, we would say that the rate change would be equal to the actual claim ratio minus the expected claim ratio divided by again the expected claim ratio. So here in this case, the actual claim ratio is compared with the expected claim ratio, and then the rate is adjusted accordingly. And the actual claim ratio is calculated by dividing the incurred claims and the claims disbursement expenses by the earned premiums. And so we know that the expected claim ratio is the percentage of the premium that is expected to use to pay claims. The calculation of bonus also becomes important in the case of life insurance while factoring in the various benefits which will be given to the policy holders and while making the premiums. Because as we know that in the case of life insurance, there are endowment plans, and in the case of endowment plans, there are again two types of plans which are with profit plans, and the other one is without profit plans. With profit plans are also known as the participating plans, and without profit plans are also known as non-participating plans. To understand it quickly, with profit or participating plans are those plans which are eligible for bonus, whereas non-participating plans are those plans which are not eligible for bonus. Now in case of the calculation of the premium, the actuaries would charge a higher premium from with profit plan policy holders in comparison to without profit plan policy holders. Now, how this bonus is generated? We would try to understand why this extra premium is being charged. Now, in the case of life insurance, the actuaries make an estimate of an expected claims. For subsequent years. Now, in a particular year, they would have made an estimate of expected claims. Now, after the end of the year, there would be an annual exercise known as an actuarial valuation exercise, which is done after the end of the financial year. Now, during this actuarial valuation, the insurance industry tried to assess the solvency level of the insurance company, whether it's capable of meeting its future liabilities or not. So during that exercise, they come to know that what were our actual claims. Now, after taking into account the total actual claims paid, if the actual claims paid are less than the expected claims, they would deduct it from the expected claims, and what they will arrive at would be known as the reserves. Now, these reserves, again, we can't call it as a profit of the company, because the profit of a life insurance company cannot be calculated on year-to-year basis, because insurance is in a long-term liability business. So therefore, theoretically speaking, they would be able to calculate their profits only after the end of the contract. So they have to factor in their future liabilities also in it. They have to set apart, because since premium are based on level premium concept, so they have to set apart an amount of premium or amount of future liabilities, and then what they would receive would be known as the surplus. Now from this surplus, 90% of the surplus is distributed as bonus among the policyholders, and remaining 10% can be distributed among the shareholders. And so therefore, they have to price it accordingly. So therefore, these reserves are due to level premium, because insurance companies charge extra during the initial years, because there has to be a constant premium throughout the term of the policy. Because of that, there are reserves. Then, because of the extra premium charged in the with profit policies, there can be again reserves in these policies. So therefore, this was the concept of bonus in this case. I hope this premium calculations clear to the participants, and the participants should know how to calculate the life insurance premiums. They can do some simple exercises to calculate the life insurance premium. They can also do some simple exercises to calculate premiums for, say, motor insurance, for fire insurance, by studying the tabular premium of other companies and calculating it practically like a live project. Thank you.